What do you think? Are you on board with Goldman's call on tech? Stay long and strong, even through the volatility.
Of course I'm not. So I actually put out a note to my clients last week saying that it's probably the end of FAANG or the top five's relative wild outperformance compared to the broader market. And I think what we've seen is we've seen complete mania in the past 3 or 4 weeks, excluding last week. And I think that party is probably going to come to an end. Now, notice I'm saying relative outperformance. This does not mean I think they need to go down a lot, they need to crash, but they need to take a pause. It's just been too fast and too furious. And if we get back to the Goldman note in particular, when I was a wee baby intern in the 1990s, I had this phenomenal opportunity to go back 20 years, so like back to the 1970s, and look at the top 120 market strategists and technicians and chart each of their predictions versus the Dow over that time period. And what you see is market strategists and technicians are wrong all the time, like all the time. So when I read a note like this, what I think is Oppenheimer's a really smart guy. This is an interesting opinion, but I'm going to take that, I'm going to take others, I'm going to take my own thought, and I'm going to couple that together and come out with my own strategy on this. What I think is there are another 490 companies in the S&P 500, many of which are trading at huge discounts, and those are where I'm looking right now. We also need to remember the Nasdaq, even after this correction, is still up 26% year to date.
It is, and that's why we love having you on. It's a good point, because here's the thing. If you've owned these stocks for a while, you've probably made some money, which means, could we make the connection that a sell-off in big tech, and I've been arguing for almost 2 years, I didn't like the market structure in big tech and blah, 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 but now I'm thinking maybe I was wrong, because you sell the big tech stocks, that gives investors a lot of cash. They've made a lot of money that they might be able to put to work in other names, the ones you're talking about.
Right. And in our portfolio, we've got our growth portfolio, our income portfolio. These are just two portfolios from one company, yet there's 60 companies most in between these two portfolios, most of which are trading at a fraction of the market multiple, many of which are still down on the year, many of which have high dividend yields. There aren't only 5 stocks to invest in. There are hundreds and hundreds of stocks. So you can look at things like American Express that's still down on the year. You can look at Intel that's trading at 10 times and is down a lot. Navient, AT&T, IBM, Verizon. Some of these are way better than bonds. Many of them are still down. They have fractions of multiples. Yes, you can all beat me up on the fact that they're not growing as fast, but they do produce huge cash flows and have a lot of value in them. Not necessarily value stocks, but they offer value to an investor.
Well, Jenny, as we talk about this, Nasdaq futures are now down 300 points. I can tell you, and I know the numbers get bigger, and I understand percentages. I went to an engineering college for Pete's sakes, but I'm not sure that I've ever seen Nasdaq futures down 300. Now they're flopping. That's the Nasdaq 100 is down 222. Nasdaq futures overall down 300 points. So you mentioned some of the names. Is it maybe time to rethink our idea of what growth means? Maybe growth doesn't have to be the company is growing. Maybe it means your investment portfolio is growing, even if the companies aren't.
Right. And I think that's where you separate growth from capital appreciation. Some of the bottom part of the market, and I really mean like 490 companies or 450 companies. So it's not really just the dregs at the very bottom. But some of those offer better capital appreciation potential from the stock price right now than maybe the FAANG or the top 5 do right now. I think when you say growth, Brian, one of the things that I'm really focusing on is the magnitude of growth that is expected right now versus the likely sustainability of that growth. Don't forget, these companies have become humongous. So to repeat a 40% EPS growth number is going to be harder and harder and harder. Yet many of them, like Amazon, are priced as if that 40% annualized EPS growth will sustain for a really long time. It's not going to happen. They're just getting too large for that to continue on forever. Yeah. And if we are afraid of higher taxes coming, guess what? You may want to be taking your capital gains sooner rather than later. And there's the threat of government regulation. So there really could be a wet blanket coming in to start to lay on top of these big guys.